Okay, let's take a look at this company. This company invested as a long-term investment. Florist International, they're the investor, okay? Purchased 20%. So normally that would mean the equity method, because that we assume 20% gives them significant influence. They bought 8 million shares for $30 million. The fair value in the book shares were the same, so we don't have any depreciation to worry about. The company realized that this investment typically would be accounted for under the equity method, which we talked about, but they've chosen to use the fair value method, and they're allowed to do that. They can opt to do that. During the year, they earned net income of $20 million. So normally, under the equity method, we would be taking 20% of that as an increase to our investment, but they've chosen to use the fair value method, so they're not going to do that. We have cash dividends of $1.25 per share, and the fair value at the end is $25 million. Okay, so how would we account for this? Well, we'll classify it on the balance sheet as what it is. So the balance sheet will show that it is what it is. It's a significant influence investment. That's how we'll classify it. Doesn't mean we have to account for it that way, though. Okay? We can account for it using the fair value method, and that's what this company's chosen to do. So let's do that. So let's see, what did they buy? They bought 20%, 8 million shares for $30 million. So their investment is $30 million. So the investment in the nursery supplies is $30 million, and it cost them $30 million in cash. Because they're doing the fair value method, we're not going to recognize the income. Okay? The cash, so there's none here. Now we get the journal, we get the dividends. So we have 8 million shares times $1.25 a share. So we have 20% of 8 million times $1.25. That gives us a total of $2 million in our dividends. So we get $2 million in cash and $2 million in investment revenue. Again, remember, they've chosen to use the fair value method, not the equity method. And at the end of the year, they're going to recognize the fair value of the shares is 25. We bought it for 30, so we have a $5 million unrealized holding loss. So we have to have a fair value adjustment, a credit of $5 million, and a debit to the unrealized loss of $5 million. Now this fair value adjustment reduces the value, the holding value of the company. Now, so we're still going to be showing this on our books as $30 million. Now, they don't ask us this, but let's just figure out what would happen if they used the equity method. They bought it for 30. Okay, the company had $20 million of net income, and we bought 20%. So we have 20% of 20 million. That would be 4 million. Minus the 2 million in dividends. So if we chose the equity method, we would carry it at 32. We're choosing to use the fair value method. So we're going to show it on our balance sheet at 25. And we're going to have that 5 million in that suspension account that we will reverse when we sell it and recognize the gain or loss.